A basket of assets, including stocks, commodities, bonds, currencies, derivative products, and more recently, Bitcoin futures, make up an exchange-traded fund, ETF. It is a type of investment product that may be bought or sold in a single transaction on a stock exchange. Shares of ETFs represent a portion of ownership in a portfolio managed by fund managers that employ a passive investment strategy. In this video, we will explore ETF, its working methodology, types, and how to pick the right EFT. Also, we will discover the EFT versus index fund. What are the benefits of investing in ETFs? Investing in ETFs may be the best option if you are searching for a cheap, tax-efficient approach to accessing various asset classes. Here are a few of the factors that make ETFs so popular among investors. You may access asset classes with ETFs, such as domestic and foreign equities, bonds, and commodities. Operating expense ratios, OERs, for ETFs are often lower than those for actively managed mutual funds. To satisfy a range of investment objectives, ETFs combine the traceability of individual assets with the diversification of mutual funds. For various reasons, ETFs are frequently thought to be more tax-efficient than actively managed mutual funds. ETF versus index fund. An ETF and an index fund vary primarily because an ETF may be traded, bought, and sold throughout the day, whereas index funds can only be transacted at a predetermined price point at the close of trading. A form of mutual fund known as an index fund follows a specific market index. Both are passively managed investment vehicles created to mirror the performance of other assets. Thus, it is only logical that they get confused. Since ETFs trade like shares of stock on exchanges, they may be easier for ordinary investors to access and trade. Additionally, they often charge lesser fees and have higher tax efficiencies. Types of ETFs. Let's have a look at the common types of exchange-traded funds. Passive ETFs. An exchange-traded fund, ETF, that mimics the performance of the whole equity market or a particular industry or trend is known as a passive ETF. Passive ETFs replicate the holdings of a specified index, a group of tradable assets thought to reflect a specific market or industry. Key points of passive ETFs. By replicating the holdings of a specified index, a passive ETF aims to duplicate the performance of the whole stock market or a particular sector. They provide lower cost ratios, more transparency, and better tax efficiency than actively managed funds. However, passive ETFs lack flexibility, are disproportionately weighted toward the most valuable firms in market size, and are vulnerable to entire market risk. Active ETFs. An exchange-traded fund that is actively managed deviates from a passive investing approach by having a manager or team make choices about the underlying portfolio allocation. A benchmark index will be present in an actively managed ETF, but managers can alter sector allocations, make market time transactions, or otherwise vary from the benchmark index. Key points of active ETFs. An exchange-traded fund that is actively managed has a management or team that decides how to allocate the underlying portfolio. An actively managed ETF often doesn't follow any passive investment strategies. A benchmark index will be present in an actively managed ETF, but managers are free to stray from it as they see suitable. How to pick the right ETFs? You decide whether to purchase a fund if it is well managed and employs the proper approach. If you're not attentive, trading expenses might reduce your returns. The fund's liquidity, bid/ask spread, and propensity to move following its genuine net asset value are the three factors you want to watch for. Funds that trade at tighter spreads than those with lower daily trading volumes or fewer assets under management tend to have higher average daily trading volumes and more assets under management. For instance, an ETF that invests in S&P 500 stocks is likely more liquid than one that holds investments in Brazilian small-cap stocks or alternative energy firms. It's only logical. That brings us to the end of this video. If you love similar content like this, take a look at my other videos. And if you like it, please smash the like button. and make sure you subscribe to the channel and hit the notification bell. If you have further questions, feel free to comment down below. See you in the next video.